Hey, good morning, investors. My name is Stuart Cruz, and welcome to KAM's Chart of the Day. Today, we're going to be talking about interest rates. Not really in the news right now. Well, they're kind of always in the news, but nothing really much is happening relative to what's going on out there. The election coming up, a lot of technology high flyers are being pulled back. We're not hearing much about interest rates other than the Fed funds target rate is at 0%. But that's why it's important, because we're going to see where we're at, see where we're going to go, and see what kind of effects some of these changes might happen before they actually happen. So here up on our charts from our friends from Y Charts, we have a chart from 1976 of the 10-year Treasury rate. And as you can see, we hit a peak up there in the 15% range, and very clearly we've been on a downward trend. And right now we are trading at 67 basis points. What that means is you give the federal government $1,000 for 10 years, you get back in 10 years $1,069.02. So you'll make a whopping $69 over those 10 years if you give the federal government the money. Now, if inflation is higher than that 0.67%, and I'm going to put the inflation rate up right there now, that's at 1.3%, that means you're actually losing money. So you give the federal government your money, and then you end up losing about 0.5% a year in purchasing power. Okay, so that's not that great of a deal, obviously. There's only been a few times when inflation has been above the 10-year Treasury rate, and we're at one of those times right now. So anytime you're in cash or bonds or something safe and secure, your inflation rate is higher than your risk-free rate. So that means your purchasing power will degrade over time. The only way you can get around that is to invest in assets that are going to appreciate with time or go up, like stocks or real estate or something along those lines. So let me take off the inflation rate, and we're going to add the 2-year Treasury rate on here as well. So now instead of an orange being inflation, this is the 2-year Treasury rate. And if you give the federal government your money for 2 years on $1,000, you're basically getting almost no return at all, 14 basis points. So why is this 10-year important? Well, as you see, sometimes they track pretty closely, and even sometimes you see the orange line above the blue line. That's when the 2-year rate is paying you more interest than the 10-year rate, and generally the blue line is above the orange line. That's called the spread between the 10 and the 2s. But if you'll notice, just about every time you see the orange line above the blue line, you get one of these gray bands after that. So here we have the orange line trading above the blue, orange line trading above the blue, orange line trading above the blue, orange line, okay? Just about every single time you get one of these gray bands. And we saw it a little bit right here, and we're in a gray band. What's the gray band? Well, it's a recession. So there is, of course, putting on the 2 and 10-year spread. I'm going to show you what that difference is here. That's the 2 10-year spread. So every time this red line falls below 0, that's when the spread is negative. That's when the 2-year is ahead of the 10-year. That's when they're paying you more interest for holding their bonds a shorter period of time. That's generally an indication of a weaker economic activity, or kind of an upside down or inverted yield curve. So we went through the inverted yield curve. Let's clean this up and take off the bond rates and just show the 2 10-year spread. We touched an inverted yield curve down here, and now we went into recession at the lockdown. You can see this a little bit more clearly, that every time we go negative, you see a gray bar. After that, we go negative, we see a gray bar. It usually happens about 6 months after this inversion, then you see a gray bar. So here we touched it, still see a gray bar, and right now our 2-year Treasury spread is at 55 basis points. So it looks like we're moving off of this, and that's a good thing, because the Fed funds rate is at 0%, which right now what I have up here is the 2-year Treasury rate and the Fed funds rate. You can see they track each other pretty closely. This orange is the Fed funds rate, and we're at 0% right now, which kind of keeps that 2-year Treasury rate down quite a bit. So the only thing that can really move, since the 2-year is kind of pegged to this Fed funds rate, and the Fed has said we're going to keep interest rates at 0 for considerable future till the economy gets back on track, is this 10-year. So when we put the 10-year on, which direction is the 10-year moving? So let's just take a look at this in a little shorter period of time. So here's the 10-year Treasury rate, and we've been stuck down here for quite a bit, trading well below 1% for quite some time. And that's the whole point, is we're trying to keep these interest rates low. And what does that mean for investors? Well, as long as the interest rates are low, as long as the 10-year is low, because if I give the federal government $1,000 and I only get $69, well, then that means it's pretty much, you know, the discounted cash flow is $1 worth about the same next year as it is the year after that, as it is the year after that. And today, well, when interest rates start creeping up, then the dollar next year is worth less, and the dollar year after that is even worth even more or less. So I know I'm jumping around on the charts, but if we add the inflation rate onto here, we had a, you know, down here we have almost a no inflation. So that means that every dollar that you have today is basically going to be worth the same as a dollar tomorrow and a year from now. But if your inflation rate is above your 10-year Treasury rate, the problem with that is technology companies that have had expanding PEs, the reason their PEs have been able to expand is because you have been able to count on a dollar of earnings being worth roughly the same as it is this year and next year. So if it's going to take a lot of years for a company, a tech company, to pay you back, which is what a PE ratio is, a dollar of earnings, how many years does it take you to get paid back on that dollar of earnings with a company making money? You're going to buy a stock at, let's say the stock is trading at $20 a share and the PE ratio is 10. That means for every dollar of earnings, it's going to take you 10 years to get paid back. Well, these PE ratios have expanded from 10 to 15 to 20 to 40. And that means, hey, I can wait 40 years because the tech companies are growing and a dollar of earnings this year is worth about the same next year as it is in 5 years. But if you see these interest rates expanding and this inflation rate moving up, then what that means is that dollar of earnings in 40 years is going to be worth about half as much as it is now. So we will get PE contraction, and that will cause tech companies and some of the companies that have expanded quite a bit to go up. So why are we looking at interest rates? Well, we're looking at that for the future of the tech company, because the entire S&P 500, biggest majority of it, this is a market cap weighted index, which means that the largest companies like Apple, Amazon, Facebook, these companies, Google, comprise the majority of the S&P 500. And these are the tech companies that had expanding PEs. So if we see more of this inflation, which could come because of expanded government programs, then you're going to see quite a bit of PE contraction. And since the variety of the technology companies override most of this S&P 500, they comprise the majority of the S&P 500, or at least a much bigger stake, it takes just a little bit of movement in these overexpanded tech companies to cause a downward slide in the S&P 500. And with the current PE ratios about where they're at, which is in the upper 20s, that suggests very minimal returns for the S&P over the next 5 years. So what we're going to be doing is taking a look and watching these interest rates, the 10-year Treasury, watching the inflation rate and the CPI to see if they're moving in the wrong direction. And if that happens, we're going to need to start investing in more hard assets, assets that inflate with inflation, assets like gold that inflates with inflation, maybe crypto, which is why Bitcoin is up, or even real estate, which inflates with inflation, and that is even leveraged. So the leverage amount, the amount of debt that you have on there, does not inflate. That stays constant, but your asset inflates. So what that means is your equity inflates with inflation at a leveraged amount. So these are ways to protect your purchasing power if we do see inflation, since we have low interest rates for quite some time. Okay, so I'm Stuart Cruz. We're talking about the interest rate curve, talked about the 2-year spread, the 2-year Treasury, the 10-year Treasury, the 10-2 spread, and core CPI. And this is how we invest our clients' money with the odds in their favor.